Welcome to FX Street Currencies in Play, sponsored by Royal Financial Trading. I'm joined by Ed Matz. How are you today, Ed? Ed, how are you today?
I'm very good. Can you not hear me?
Yes, I can see you on your command centre. How's that going there? Is it quiet because of July the 4th, or is it still quite busy?
Well, it's one of those things, actually, the whole process of colonisation since the American War of Independence, how Brits used to rule the world, now it's the Americans. So, bank holidays in the UK, I go out with the family, I've got my iPhone, iPad and everything, keeping on track of the markets. If it's an American holiday, in theory, it dies, and that catches a lot of people out because they expect the markets to do nothing. And then as a consequence, the robots take over, but then you get certain events, WorldPay in the UK, obviously the missile being blasted, RBA has a hangover from overnight. And, there's a lot of rotation going on and people are nervous about that. So actually a lot goes on and the market becomes thinner and becomes potentially more volatile, and people expect the market to stay in the ranges, and it blows ranges quite often because of the thinness and because people aren't actually looking at what history does and what markets tend to do throughout holidays. And then we've got FOMC as well. So it's actually it's good opportunity to take stock of what's really going on a relatively potentially quiet day. But be wary of some of the volatility, and some of the moves won't be sustained. So don't get too carried away by what happens on holidays, but they're still worth looking at.
Well, you said America rules the world, but obviously Kim Jong-un seems to be firing his missiles, obviously flexing his muscles.
Well, I thought he was celebrating Independence Day early.
Maybe that's what it is. I think we obviously got that bit of news flow wrong. But let's have a look at the official headlines today. Aussie dollar negative on not hawkish as expected RBA. A lot of volatility last night in that cross, and then the yen stronger on risk off after North Korea missile launch. Gold firmer, obviously, in the wake of that potential end of the world scenario, safe haven demand, and then July the 4th holidays, as we've just discussed. What are the highlights there for you on those four particular headlines?
In fact, unfortunately, I don't have a chart from you. North Korea is an interesting one because it's something that's brewing for later. Looks like it's going to have a run at 220 and back off and trade the range. So this is a bit of again, if you want to call it Independence Day fireworks, that's basically it. It will be another flash in the pan for now. The RBA, the market, it amazes me how with the Aussie actually going sideways, it's very indicative of what the period we're entering, which is classic, I call it the July chop, where markets tend to go sideways. There's no real trends, particularly in foreign exchange, yet people think there are trends developing. And the Aussies come, broken back down, as you said, on less than hawkish news out of the RBA. Looking, in fact, I don't know if you've got a chart there that I sent through, but it's looking suspiciously like October 2010 RBA meeting. Basically means that, although in fact I'm sure Aussie and bearish, because it effectively is at 71.40, but like 73.50, 77.55 range, and therefore should come back down. This is a spoof. So I wouldn't be at all surprised to see Aussie go back up in the next 48, 72 hours as the market overdoes another interest rate moves. And not surprising, because the central bankers say one thing one day and say another thing the next day. And I thought they were supposed to be introducing stability into the system, and yet, particularly with balance sheet reduction and the line from the Fed, they're likely to do the opposite. But hey, that's volatility, that's why we're here.
Well, let's have a look at some of the charts you sent. They're very smart charts from Matrix Trade. That's what we expect. What are they telling us?
They're actually telling us, be careful. Although the markets are in ranges, you've got to be careful of the ranges. What typically happens in the run-up to a holiday is the likes of you and I say, well, it's going to be nothing doing. You scale back. But the robots don't. The robots don't know that you've got a barbecue lined up in the back garden for Independence Day, or you're going to burn a few effigies of Livingston and the like. What they don't know, so they carry on trading. So they'll push levels, they'll do what they're necessarily programmed to do, but because they represent a larger volume of the market, they'll drive the market even more. And because robots, if you like, HFTs, even though they're very short term, are necessarily programmed to do the same thing, history repeats itself. You got those charts there in both the euro dollar and dollar yen. You can see they're both tracking what they normally do through Fed holidays, or Independence Day holidays, and Thanksgiving and the like, which basically is really kind of interesting because it's saying that the euro dollar Going back a week, I was talking about a 112.80, 114.30 range, spiked a little bit higher. It's coming back down to the bottom of the range, and there'll be a buy again in the short term with July chop consolidation. But perhaps more interesting is, and I don't think it's got anything really to do with North Korea, is dollar yen's getting decidedly toppish here. And again, a range. I mean, what's the range? 108, 114, getting to the top of the range. Don't get carried away. Be careful, very careful now, of translating yen as a surrogate for stocks. The yen has been driven by US interest rates, and stocks have been eclipsed in that relationship. So you've got to be very wary of that and look at what yields are doing, and they're looking a bit overdone in the short term, which would support the idea of dollar yen coming back in the range.
Okay, let's have a look at the next chart.
Well, obviously, I don't know how, most of the people listening in, how, their time frame, whether they're just, where's the next 8 hours or the next 20 minutes or whatever. But right hard on the back of Independence Day, we've got the Fed. And there's two things going on with the Fed. The one is the expectation of higher interest rates, and the dot plot, whatever that means for the future. And which is interesting because it now looks, to me at least, the Fed's got a little bit ahead of the curve, or the market's expectation of the Fed's got ahead of the curve, and people were expecting excessive tightening, which hasn't been justified either. You've seen a turn down in economic growth. You have a turn down in inflation. Curiously, as a complete aside, anyone wants to freak out, what is really exciting is these are exactly the same conditions to the run-in to the tops in 1929 and 1987. Economic growth turned down a few months before, and then inflation turned lower. It's a fundamental sell signal, but that doesn't mean it can't go 10% higher before it goes down, because it's fundamentals. So on terms of the Fed, I think the big issue, and again another issue that people haven't really grasped the full extent of, is balance sheet reduction. It's the opposite of quantitative easing. Quantitative easing wasn't printing money, but effectively was giving the banks, by buying bonds off them, putting money in their reserve account, gave them the ability to lend more and do more things. Balance sheet reduction means the opposite, which means the banks will have less money, less ability to lend. They will be buying fewer bonds. They won't be front running the bond auction so much, which means the bond market and yields will start to firm through that process. If you remember the beginning of quantitative easing, then the dollar went down. Then this will give pressure, this will give support to the dollar through the early stages, at least the early stages of balance sheet reduction. So what is why I think this is a major bear market in the dollar, and we're looking at going into the Fed, which basically says euro dollar is going to be toppish back in the range. You can see what it tends to do into the Fed minutes rather than the Fed itself. And dollar yen also supports the Fed holiday idea of dollar yen being very toppish here. So that means basically highlights, I think, the shorter term. You want to talk trades? Is this what you want to do?
Okay, let's move along to the next section, which is the hourly dollar yen, and you've got all sorts of shenanigans going on here, but basically the message is toppy initially, is that correct?
Yeah, this is very similar to the beginning actually of the downtrend in dollar yen, where again people are forcing the issue, it's a bull market, bear market, it's turning. I think dollar yen is potentially the most interesting dollar market out there because it's leading the pack by months. Dollar yen is typically the first one to go within the pack, primarily because it's the one closest to US yields. And what it's actually doing at the moment is going sideways. This is a work in progress. There's lots of pretty lines and numbers flying left, right. But basically, it's a range, and you can see that trend line coming in at 113.55. I have a sell order at 113.55. Stop above the previous high, 114.30 for yet back down in the range. A July trade, if you like, a July chop trade. And even though I'm bullish and long stocks, that correlation hasn't broken entirely, has a nuance, but is not so forceful as it has been.
Let's go on to euro yen, because time is of the essence.
Tie everything together. If I think euro dollar is within the range, it means it'll go back up to the top of the range, and dollar yen is toppish, then it really does highlight euro yen as a potential trade. And I personally, what I'm looking to do is to leg into. I'm selling dollar yen, and when euro dollar bottoms at 112.80 or gets below 113, which I think it will, and goes back to the highs, then I'll sell euro dollar, and then I'll give myself a euro yen. For what is I'm not 100% convinced by this scenario, but It's certainly following previous price action and what it did before. So it looks like it's going to fade for at least 300 points. I'm not going to say no to 300 points, but at least 300 points, but with potential to do something quite sexy on the downside. And minimize your maximum regret when euro yen's 500 points low, and I thought, and I could have sold it at least on a short-term punt. I know I'm not short for what could be a potentially big move. I've missed the boat. So minimize my maximum regret. I'm going to have a punt on leg into euro yen as a potential juicy trade going through July. And I suspect the big trade will come in late August and September as currencies correlate back to stocks.
Okay, well, let's just go on to the trade of the day, which is centering around the dollar Canadian. According to Bank of Canada's Governor Polozzi, sees that inflation is well into the uptrend in the first half of 2018. Not much momentum on the pair, as a liquidity drain from Canada yesterday and from the US today are weighing on the movement of the pair. Oil seems to be capped around $47 a barrel, with the US Baker Hughes oil rig count dropped and rising output from Libya and Nigeria offsetting each other. Sell dollar Canadian at 130 with stop loss at 130.50, take profit at 129.30. Risk to reward ratio at 1.4. And then positions of traders. Long rather, of mostly long of euro dollar there, 64.34, long-ish of pound dollar, very short of dollar yen, which Ed will be pleased with that result there, and short of dollar Swiss and dollar Canadian. Very long of Aussie dollar, which looks rather painful as far as this morning is concerned, and long of euro sterling. Finishing off with the economic calendar, which is rather thin, as you would expect. Market manufacturing PMI for June in Canada. Thank you to Ed. How are you going to keep trading for the rest of the day, Ed?
I never stop trading, it seems. I trade the gambit longer term down to scalp quite a lot. Not just necessary to keep myself occupied. I would never do that. But there's a lot going on, a lot of opportunities. I think we're entering, Zach, the most exciting period for a decade. And that will not be reflected in the next month, I don't think, not certainly in currencies. There's going to be a lot of two-way chop going on. But come late August, September, October, if you're planning a holiday, take a Christmas holiday, yeah? And hopefully money you.
Thank you very much, Ed. That's it for FX Street Currencies in Play, brought to you by Royal Financial Trading, and thank you to Ed as well.